morning, Bob.
Good morning, Bill.
We're not quite to summer. It feels like it in Mississippi, but we're not quite there yet.
Yeah, I'm ready for it.
You ready for summer?
Yeah, absolutely.
What is it about summer? Snow cone, or what is it about summer? It's just...
Oh, you take the whole summer off. Did you know that?
Well, that's the academic way. That's the academic way. I figured your blood might get a little thinner in the summertime. Well, look, we're amazingly looking at 10-year rates that are below 2.5. Now, it's above 2.5 this morning, the yield on the 10-year, but it's been below, well below 2.5. It touched 2.42.
All right, and it's been coming down. There was an article on Bloomberg yesterday, maybe this morning, where they were talking about the fact that all the models they have for bond rates just don't work anymore.
They just don't work.
And it just keeps going up. The
price keeps going up.
The price keeps going up.
Yield keeps coming down.
Right. And, you know, a year ago, it was the 10-year was around 2.15. All right. And then it went up quite a bit.
Just up 3, touched 3.
And right now it's been coming back down on the yield.
Even though the Fed has been engaging in their tapering program for QE3.
Right, and some of the board are saying, well, as soon as the taper stops, as soon as we finish buying all of this,
time to raise rates.
Time to raise rates. I think some of them are just totally out of touch with the world. You know, I don't think that, you know, they're in some sort of bubble.
Well, let's talk about the international impacts and bring it home. So how about Europe? How's Europe doing?
Well, you know, Europe's not doing well. You know, Europe has have gone through some really bad times, and things are not getting any better. And interestingly enough, one of the reasons that people talk about the fact that this is a sort of sustained situation, the rates are continuing to be low in Europe, is that despite the efforts of the European Union to raise rates and to put in austerity and everything, the percentage of, or well, let me say, the total number of working age population continues to decline. People aren't taking that into consideration.
So they're just leaving the workforce.
Well, not only leaving the workforce in terms of age, which is something that the demographic, the baby boom is moving through the
just
pipeline.
Being discouraged?
But discouraged and
so
just
they're just going out to the vineyard and drinking. Oh, what a great deal.
And when they do that, they're not spending. They're not spending like we are normally spending.
But they're having a big time.
I hope so. And you know, in the last report, personal income in the U.S. was up, but spending was actually down. And we're seeing a lot of that. And as you get more money into savings, what happens? Well, downward pressure on interest rates again.
That's absolutely true, because what we need is we need consumption.
We need consumption.
Historically, 2/3 or more of our economy has been consumption.
Yeah. And
if people don't spend, then we have problems.
Right, and there's a
asset prices tend to go down. I mean,
yeah.
Look at the first quarter; it contracted 1%.
GDP was
at a rate of 1%.
Yeah, down 1%, which is amazing. Now, the second quarter is going to be back up, so we're not going into the...
That's what we think.
Well,
all right, it appears that way.
You've got it on good word, Bill, I'll tell you.
It appears that way, all right, that it's going to go back up. It does, it appears that way.
Yeah, I think it will.
And so we had all sorts of blame for the first quarter. The weather, the whole deal.
Yeah.
But the fact of the matter is, the numbers are what they are.
Right, GDP went down. And
so it's hard, when you think about it, it's hard to raise rates in that environment.
Yeah, I mean, we've been in a situation for a long time now where nothing is moving the economy.
Let's talk about China. China's got major problems with their banking system.
They absolutely do, and they've been a real source of buying a lot of U.S. securities.
They have been. They've been taking a lot of that consumption, that worldwide consumption. China's been a big player, but they've got major problems in their banking system.
Right. And, you know, if you're sitting in China and you're looking at the different ways that you can invest your money, and you're seeing their Chinese economy sort of tanking.
You don't want to. I mean, you don't want to take principal risk in a situation like that.
Exactly, and so you know the flight to quality, U.S. Treasuries,
which drives the price of Treasuries up and yields down.
Exactly.
And so you would think that would manifest itself in, since rates are going down, housing affordability is very good. You would think people would be out buying houses or refinancing. But we're not
Yeah.
seeing that.
No, and you know, there was a report.
I mean, we're seeing some of that, but not in any drastic
Exactly.
measure.
I mean, and we saw a report that came out a couple of days ago that said that 2 million homeowners are currently facing a reset of their interest rate
Right.
on the adjustable, and 40% of those are still underwater.
So
So they can't afford it.
basically, they're either going to have to foreclose or refinance.
Exactly. And they may not be able to refinance because of the nature of their current economic situation. If their house is underwater, banks are not really likely to want to refinance that house.
So let's talk about demand for housing. It's all driven by employment, and so let's
Correct.
talk about that. We're just not seeing those numbers. We're seeing some numbers in moderation, but
Right.
we're not seeing strong rebounds. In fact, we're overdue for a recession, another recession.
Exactly. It's not a good situation right now, frankly. And the only way that we are going to pull ourselves out of this is for to do something that's extraordinarily unpopular.
Like spend a bunch of money.
Spend a bunch of money.
You've been advocating that for 5 years. One day you're going to be right.
Well, I've always been right, Bill.
Everybody else is just going to see it.
Right.
Right? Okay.
Eventually.
It's just going to become, I believe, as you economists say, self-evident.
Well, it's been that way.
So let's talk about that for a second. We go into let's take some scenarios. We go into another recession, if that happens, will rates go lower?
They can't go much lower, Bill. The federal funds rate now is 0.5% or something, and what are they going to do? Lower it to zero?
So they could do QE4?
They may have to do something like that. That's the only thing that they would be able to do, unless there was some change in the thinking of the U.S. Congress and decided to do some major expenditures,
Fiscal policy.
fiscal expenditures on
Infrastructure. Need to spend on infrastructure.
a variety of things that they could do that are needed and would generate jobs, and then that would start compounding in the
People
other
would feel
direction.
better, have money in their pocket,
Right.
that sort of thing,
Exactly.
and then we would go the other way. All right, so let's take that scenario. So another scenario instead of a recession is we're in this blasé period where
Sort of like Japan has been in for 15,
we're,
20
we're,
years.
we're,
Yeah.
we're in this slow to no growth period. Rates stay about where they are.
All right,
Housing stays about where it is.
exactly.
In a much lower pace. We're down to numbers we've seen in the late 90s, early 2000s.
Yeah, it's very, very weak, and we just don't see any way it's going to change right now. Everybody keeps looking around the corner and saying, well, it's got to get better
Next year.
next year,
15. 15's our year. 15's our year. The problem is 15 comes and goes, and it's 16
All right,
and 17.
It's been a long time now. We've been doing this for quite a while, and the other thing that we've talked about in the past is that a lot of the younger people who are going into the market, who would normally be out there buying jobs, are worried.
Buying houses, they're getting jobs and buying houses.
Right, and one of the things that they're worried about is that a lot of these companies now are expecting them to be able to move at a whim.
Right.
And when they can't sell their house, they're not going to want to get into that.
Buy a new one.
Exactly.
And
And
so
so they're stuck, and so what they're doing is renting. And so
we're
there's
seeing
that
rents go
demand.
way up.
Rents are going up. The demand for rental properties is up significantly. But the demand for what we would normally think of as residential consumption is just not there right now.
Well, so where will we see rates into the year? Mortgage rates into the year 4.5.
I think it's going to stick around right there.
It's
right
4.15 today. According to Bloomberg, the 30-year fixed rate you can get for 4.15 today.
Uh-huh.
That's an average. You probably get. I've seen some advertisements for 3.99.
Yeah.
But
Yeah.
but 4.15 is an average. Where do you think we'll see them into the year? 4.5.
I don't
Or
think
about
they're
right
going to
here.
go up. I think sometime where between 4 and 4.5, it's going to stay right in that range for the rest of the year.
And so demand picks up.
Not much.
So-
There'll be a seasonal demand over the rest
Second,
of the
third
summer.
quarter.
Yeah, and then after that it'll drop way off again. And we're going to say it's just around the corner.
Well, we're full of good cheer this morning. It's the summertime, almost the summertime. We're still in spring. The summer solstice is almost upon us. And so I believe it's June the 21st, 22nd, along in there. I don't know the exact day, but June 21st, 22nd. This is FNC's Morning View. We're out of time. We hope you have a fantastic remainder of your spring. I'm Bill Ray with Bob Dorsey. Bye-bye.